So we're streaming live on YouTube. First time I've ever done this, and we also have a live webinar. So you'll see down the bottom of chat, and you can ask questions if you wish to do so during the presentation. So it's live on YouTube, live here. Only here can you ask questions. And I'm due to start in 1 minute's time. And I'm going to talk about how to use your money. You can ask questions if you wish to do so during the presentation. Not listen to myself. So it's live on YouTube, live here. Only here can you ask questions. And I'm due to start in. Let me get rid of that, and hopefully I haven't got rid of my Zoom. Yep, I got rid of my Zoom. Okay, so that was echoing. So I think the live stream didn't go. Hang on a second. Okay, so yeah, let's see. Okay, so we got I think 200 people watching, and a big welcome from me wherever you are in the world. I'm going to talk about how to really make your money work for you and just reduce risk. I want to change some people's thinking. You know, when we think about money, then we always think that, hey, it's a risk. You've got to take a risk. And if you take a risk, you're going to get a higher return. Is that always true? Okay, I'm not sure it is. So I actually think that there's ways of investing your money where you can literally make great returns and reduce the risk. Okay, so that's a bit unconventional. Most people would say you need to take risk, and the more risk you take, the bigger the return. Okay, I'm going to try and prove to you that's not necessarily the case. And I'm going to talk to you about why I think that steady actually wins the race. So please let me know afterwards if you have ideas or you want questions. Okay, as I say, I'm going to do live questions as indeed we do the presentation. So first of all, let me share my slides with you so everybody can see them as I go through them. And I'm going to try and just give everybody a real good indication of exactly, for me, why people should be going into the right areas at the right times when it comes to investing money. Okay, and that is not showing behind me. But nevertheless, okay, hopefully you can see it. All right, so hopefully that's super clear for everybody. Okay, let's go for it. So first thing I think everybody needs to get in their mind is that if you are an ordinary individual, you go down the bank, you go down the high street, you probably end up in the bank. Okay, where do you put your money? Put it on a platform. I know the facts from Saxo. You put it on an investment platform. 73% of people lose their money within 12 months. Do-it-yourself financial services doesn't work. So how do you choose the right fund? How do you make sure that you've got the right thing, the right product for you? Okay, so I'm going to talk to you really more as an education, just show you the sort of things that you can do so you can make a decision, a better decision on how best you can invest your money. Okay, deVere, we have a investment banking license, and that investment banking license allows us as a company to make sure that we are getting you higher returns. So just imagine if you're going to Goldman Sachs, you need 50 million to get in the door. You probably need 10 million liquid before they're even talk to you. Okay, at deVere, we believe that investment banking should really be available for the vast majority of people. Why? Very simple. deVere Investment Bank can go to organizations and we can just get you higher returns than you can do as an individual. It's bulk money, if you like. As a company, lots of clients all over the world, 100,000 clients, they invest money. deVere Investment Banking can then go and get the best funds, the best products, the best ETFs, the best bonds, the best assets for you to make money. Money makes money. And of course, if you're in a company where lots of people are investing, then you've got a much better opportunity, a unique opportunity of actually making money. Okay, we all know that we need new ideas in today's world. The world's changing fast, so how can you do it? And of course, deVere's changing as the world is changing. Okay, you may have seen at the weekend, Mike Tyson in the boxing ring. Okay, you might have thought it was a bit sad. Okay, certainly a 58-year-old taking on somebody half their age. I mean, did he do it for fame because he actually wanted the glory and to show what he could do? Or was it actually about money? Okay, many of us would look at it and go, well, it's probably about money. Okay, but it's a great example, of course, a recent example of many, many people that earn money over a lifetime. And you say, well, I don't earn so much money. Well, just think over a lifetime, whatever your salary is, whatever your income is, it builds up. And over a period of time, people actually earn millions of pounds, millions of euros, millions of dollars, but it disappears simply because they spend it on things perhaps they shouldn't or don't invest it wisely. Definitely when we talk about Mike Tyson, he did that. He bought a gold bath, evidently, for his soon-to-be ex-wife. She hardly used it. He spent 2 million on that. He had bad advice. He bought a couple of tigers, believe it or not. And really all I'm trying to say is he invested, had bad advice, and guess what? He went from 300 million to zero. He actually went bankrupt in 2003. Okay, if he'd have invested that money, maybe he should have met me in 1990 when he had the 300 million. If he'd have met Nigel Green and I gave him a steady return of 7%, look at those figures. Wow, what stats. He'd have actually made, or have today, 3 billion. Okay, I asked you the question. If he'd have had 3 billion, would he have stepped in the ring? Okay, and again, you may say, well, these are big figures. You're right, they are. But the same principles apply to you and indeed me. Okay, we shouldn't waste our money on things because ultimately, every single one of us need money for our future. You can talk about health, as I often do. And when we look at health, we know that, guess what? Some stage in the future, you might not want the government to be looking after you. Okay, crazy stats, and these are in Australia, but it's true around the world, that in reality, if you don't have sufficient money, you're more likely to actually have a heart attack. Guess what? Stress, heart disease is the biggest killer of people. The biggest cause of stress is, guess what? Worry. Biggest cause of worry is money. 3 times more likely to have a heart attack or get cancer if you don't have cash. Okay, you can see the importance. And I don't want to be negative, but I actually want to say to you that there are ways to invest, and not investing is not a good choice. If you look at Ty here is a little quote. It's a small amount there on the investment. Okay, and when we're talking about the small amount on there, we're actually saying that you're investing your money, and okay, at that stage when you're investing it, it needs to grow. Okay, being poor, he's talking about, and he's talking about extreme here. But if he's talking about a small amount of money, then guess what? Okay, then if you can't afford to clean your teeth, the principle's the same. Ultimately, you end up with a root canal needed, more pain. If you don't change the mattress and get yourself a new one because you can't afford it, okay, one day you're looking after your back. Okay, or if you don't get the lump checked out, because guess what, you're either scared or you actually don't have the money to do it, well, guess what, one day you're dealing with a bigger problem. It's the same principle. Okay, however, I don't want to be negative, as I suggested just a second ago. Okay, I want to go for the positive. What do we want to do in the future? What do you want to do? Okay, well, maybe a nice car. Okay, that you want to buy. It might be that you really want to make sure you've got a house or 2 or 3. It may be that at some stage in the future, you want to make sure that your children have a fantastic education. Of course, all of those things cost money, and you need to be able to accumulate money. And of course, at some stage, you probably want the option not to work. And when you do that, maybe it's lots of holidays, or maybe it's even holidays while you're working. But again, in order to do that, you need to have money to be able to do it. So how do you invest your money? Well, lots of people leave their money in a bank account. And of course, if you leave your money in a bank account, in general, you get zero. So I just think people kind of go, well, it's only a small amount. So if it was 5,000 or 50, the principle applies. So if you had, let's say 50,000 to give you an example, and if you say it's 5, then that's fine. But lots of people leave their money in a bank. Hey, what do banks do with your money? They lend it to someone else. So if you put your money in the bank, even if you get a deposit account, they're going to give you a tiny piece of interest. In general, for most people, they got money in the bank account and they're getting zero. Okay, if you just made 7% on 50,000, just see what happens over a 15-year period. Just at 7%. Okay, that 50,000 becomes 137,000. Okay, if it comes at 9%, 182. That's even more exciting. And if you look at 25 years, it's crazy. That 50,000 is worth over $250,000 just at 7%. And of course, it's nearly $500,000 when we talk about a 9% return. 2 things here. 1, don't leave money idle. If you leave money idle, don't get it working for you, then you're just wasting money. You're losing it. You're literally taking it up, tearing it up, and throwing it away. That's not obviously sensible. To make it work is good. And of course, the better return you can make without too much risk, of course, that's got to be good for everybody. Okay, so what stops people investing? Why don't people invest money? Okay, well, one of the reasons they don't is because volatility scares them. Maybe they've even invested money at some stage, perhaps put it in a stock exchange or similar. And they've invested that money, and guess what? All of a sudden, they've ended up with shares falling, and maybe they take it out. That puts them off. Okay, in fact, if I just show you the next slide, you'll see that in most people, when they look at it, particularly new investors, would you like 7%? Sounds boring, right? 7 each year for 5 years. Okay, or would you like something where you get 10% in the first year? You're beating the 7, right? But there's minus 25 because there's a market problem. And then the next year you do plus 10. And the next year you do plus 25. Wow. Okay, you're really doing well. You've done 25 and 10. Okay, in those years, next year's a little bit of a fall off, 5%. Which one would be better? Okay, well, you'd be astonished to know that when you actually look at those figures, the second option, the one that looks better, gives you 107,000. And it's actually worse than that because most people, they actually get the minus 25 and they withdraw their investment. It actually pays to be steadily accumulating money, which is what I'm talking to you about today, because the consistent 7% smashes out of the park the volatile and the volatility that potentially you get if you're certainly invested in the wrong areas. So how can you indeed get that percentage? Okay, well, when we talk about investment, we've got a bank lends the money to someone else. So the rate of interest is going to be governed by what they can charge other people. And of course, sometimes they lose the money because they lend the money to the wrong people. So you lose money in terms of inflation. So now we've got investments. What can we do? Okay, well, companies issue, they're called debt instruments. They issue bonds or credit instruments. And let's say it's Barclays. They say, we want to raise some money. We are prepared to issue a bond, fixed rate. Okay, and you'd get probably Barclays 5-6% per annum in the bond. So you've now got a bond, which is a fixed rate. Okay, or they can issue shares or equities. And the difference is that equities, they move around because equities depend on the profitability of the company. So if they have a harder time, then guess what? Dividends go down and the equity price tends to go down. So bonds tend to be more steady. Equities in a good market outperform bonds. Okay, but right now, for the first time in 22 years, that's massive. All of a sudden, we're in a situation where bonds will give you the same return as equities and concerned with a dividend. It's very rare. Normally, equities, because it's more risk, they will give you a higher dividend than a bond. Right now, we're in a situation where bonds will give you a steady return. So as a company, what we've done is we've gone to the marketplace and we've looked for who is the best. Okay, we found a company called Coolabah who've got, we believe, the best bond fund in the world. Okay, they manage money for 31 large institutions. In fact, when I'm talking to them, they don't talk about 1 million, they talk about 1 billion here and 1 billion there, or 10 billion. They're talking huge amounts of money. However, deVere, because of its size, first one they've ever done, they've produced a bond fund for us. And what they do for our clients is they not only invest in the best companies, in other words, bonds that are AA, AAA rated, so secure, high yielding, good companies. And they trade those, a bit like Warren Buffett would look for growth stock. They're looking for companies that bond rates good and steady and secure companies, but also they're looking for undervalued bonds. In fact, if you'd invested in this structure this year, you'd have made 11%. Okay, we, looking forward, would certainly look for this fund to be consistently making 7%. And the great news for a client is they can invest a relatively small amount of money, go into the fund, and there's instant access to the client. If they want to take their money out, then they can actually access it should they choose to do so. So it gives the opportunity as an individual to access things that are only normally available to institutions as an ordinary individual. Some may say, well, okay, that's great, but okay, I'd like to try and see if I can get a higher return. Well, the way to do that is, of course, to look at stock. And of course, you could within a portfolio go, we want some in bonds, well managed, because managed beats ETFs. Okay, in fact, interestingly, in bonds, there's no comparison. A good managed bond fund massively outbeats ETFs or choosing your own. Okay, you may say, well, look at this year. Nvidia's done 200%. Of course, it fell yesterday because profits were slightly below. And of course, Nvidia may well do well in the future. So what we do as a company is we have, as we say, our bond fund, deVere Smarter Credit Fund, but we also have structured notes available for our clients. Again, these are wholesale. If you were a bank, you would be able to invest in these with a large amount of money, okay, but they're not available to ordinary individuals. deVere Investment Banking, we can access the very, very best structured notes. Okay, currently we've got, for example, one which is with gold mining stock. Historically, gold stock has not performed as well as the gold, or it's, if you like, lagged it. We expect our gold stock funds or our gold stock that we produce there to actually outperform the market. Even if the market falls, this particular product can pay you 17% per annum. It's more risky than being in bonds, but you've got a bond because it's issued by a bank as a lending instrument, and you've got stock. You've got the best of both worlds, 17% per annum. You shouldn't put all your money in one place. I'll explain why in a second. Might want to invest into banking stock. Banking stocks are done nice and steady. They always seem to make money, don't they? Banks, and maybe I've accused them of that, all right, as I've been doing this presentation. But this particular product, based on equity of the banks and using a bond, would give you 19% in US dollars. And if we look at the tech one, it's got a 40% barrier. So if any of those stocks fall by 40%, you still get paid out. It's like a super, super protected opportunity to go into tech. And that would give you 16%. The only problem with structured notes, so everybody knows, is that sometimes, particularly if you've got stock, it doesn't work out because one stock in particular can, of course, fall. So you need to know our win percentage, if you like. And with our structured notes, 97% of them over the last just over 5 years have achieved a positive return. Of course, it means that 3% haven't. And of course, you wouldn't want your only money to go into the 3%. So what's always important as a client is to diversify. So in other words, forget the figures I'm talking about, maybe potentially be large, but if you had 100,000, it's actually better to put a small amount into 10 individual structured notes, because if 9.7 are winning, at least if 9 are winning, okay, well, if we said the average return was, let's say, 16%, and you had 9 winning and 1 not doing so well, okay, you'd still average 13.5% per annum, even if the one that did badly did extremely badly. So what you're able to do as an individual is, number one, understand, don't just waste money. Okay, as an individual, don't leave your money idle in a bank account. As an individual, remember it matters. Money can't buy you happiness, they say, but it can help with health. I think we'd all agree with that. But put it in the right sectors. Don't go into the wrong places. Always seek advice. Talk to a financial advisor to get the right structure for you, or visit deVere Investment. We have an app where you can see the sort of things that we do. And of course, I regularly issue videos about what we can do. Okay, right now, if you're making returns on our products, you'd expect to double your money every 5 years. To leave it there and actually dwindle, then that, of course, is not a great thing to do. At some stage, everybody wants their money working so that they're in a situation where their money is making money. Okay, a bond for you is a bond fund for you. Just realize there's different opportunities in the world than perhaps most people realize. Okay, there's a QR code there, should be on your screen, hopefully, which, okay, if you just put your phone on it, will actually take us to a website where you can book a meeting with your advisor if you wish to do so. And I just heard Emery come in, Mitchell come in the background. And okay, I think, all right, I'm going to stop sharing. Okay, he's going to ask me all right, some questions.
So we have a few questions there before.
My screen went wrong in the behind. Go for the questions.
So the first question, what is the importance of leveraging global interest rates in investment strategies?
So when you're investing money, you have to be aware that interest rates are going up. Okay, why? Because of inflation. So you can leverage it by using bonds, as we've just described here. So if interest rates are going up, then the companies are issuing bonds at actually at a higher rate. So I think we've seen recently that inflation is stickier than people expected. We're living in a world, unfortunately, which is fractured. And when you get deglobalization, if you want to call it that, nationalism, okay, then you tend to get inflation. And when you get inflation, you get higher interest rates. Governments have to put up interest rates. What Labour's done in the UK, so then I think everybody needs to think, okay, there's two ways of looking at this as well when we're talking about this. So if you think that governments can't afford to give people pensions, just a fact, right? So what you've got is we're not having enough babies, Mitchell, right? Yeah, true. So what's happened is that you've got this massive population that's getting older. Governments have got an issue. They've got, how do they look after those people that are living longer, right? And the only way to really actually create the money is to tax people. And the only problem is the more they tax people, the more people leave the country, right? Okay, so they end up with a bigger problem. So we're in a world where I think people realize they have to look after themselves. Labour's budget recently was inflationary. Okay, in other words, they're borrowing money, they're trying to get the economy, but it's actually, they're spending a lot of money. It's going to cause more inflation. Donald Trump, whether you like him or you don't like him, it's inflationary. So already the markets are saying that's going to cause inflation. Okay, well, bonds benefit. So it's a good time to be looking at bonds, just simply and solely because of that. So interest rates reflected in that. Should you leverage against it? Okay, so then just think leverage is adding to the risk. So should you? Depends on your age, depends on your appetite towards risk. So let's say you had something paying you 7% and you could borrow at 5. Okay, well, if you borrow at 5, you could end up with 7 plus 7, 14 minus 5. You're getting a higher return, but you've got leverage. Okay, so it's much more risky to leverage.
Thank you so much. Next question. How can global diversification improve portfolio performance?
Okay, well, recently America's been the best, right? So, if you look at stock in America, you go, well, that's actually outperformed everything. Will that continue? So, there's an argument for it, by the way, because America has a more flexible economy. It can move quicker, can make changes quicker, whereas you've got more red tape in lots of countries around the world. So diversification is because just in case, right? So you certainly look at America because it's always been so strong. But if you just depend on one country, I mean, let's give you a bad example. But if you had all your money in India, right? You may have seen this morning. There's a Adani family have been accused of bribing government officials. Stock's down 20%, market's down. Okay, why? Well, if all your money's in one place, okay, then you're exposed in something happening in that place. Okay, so diversification for me globally, as well as asset classes, for me, is a must. You get the 7% regularly.
Gotcha. Really important question. What are the benefits of investing in UK pensions?
So if you invest into a UK pension, well, everybody needs a pension. So at some stage, the reality is that you can't rely on the state. So it's sensible to put your money into the UK. Is it the right pension? Are there enough funds available? Because some people that live abroad move the money that's in a UK pension into an international UK pension. But then if you live in somewhere like Australia or New Zealand, other locations, it can even be worth moving your money to those countries because there can be tax benefits. So you definitely need an advisor at that stage. But a pension's good, yeah, because at some stage you're going to want the option not to work.
Good. This question is from a LinkedIn user watching us right now. Could I ask about your personal losses? How did you recover and how quickly? And if you could share how you personally diversified your own portfolio. Thank you.
How did I recover from, sorry?
From personal losses, like
Personal losses. Okay, I've always diversified. I mean, when I was younger, before I came in the business, I bought penny stock, right? So yeah, okay, I guess that attracted me to the financial industry. And yeah, I lost all my money. And so I learned about diversification the hard way. Yeah, the early days, I think you've got a choice. You're either using expertise, so you either go to an advisor like us that have spent years learning, okay, or you try and learn it yourself. The only trouble with trying to learn it yourself is you could spend 20 years trying to learn it and lose all your money, and you've ended up with knowledge but no money, right? So I think some knowledge is good for everybody, which is why we're doing a webinar today, because then you can have a good discussion with a financial advisor that's his sole job. That's all they do, and they understand it. So diversifying is the key, and if you make losses, okay, well, if you're young, you're okay, right? So for those of us, including me, that are older, it's even more important that they take this security properly, because you don't want to be retiring just at the market goes down, or you don't have sufficient money. I mean, to be old and poor is not good, I think.
Thank you. So we know you're a grandfather, and a lot of our watchers here care about the children. So they would like to know, why is it essential to specify guardianship for minor children in a will?
Okay, so yeah, I'm a granddad. Wow. Okay, so yes, I mean, if you're looking at your financial situation, it takes the whole planning, right? So if you're an expat like me who lives abroad, so then just think, people think when they get to retirement age, they won't need as much money. Okay, it's not true, right? Because you think about when you're working, you spend 8 hours working, 8 hours sleeping, and 8 hours at leisure. When you get to the weekend, you obviously spend more. Okay, when do you spend your money? Okay, you tend to spend your money on holiday time, or okay, when you're at leisure. Okay, truth is, when you get to retirement, you got more time on your hands. Okay, you know what the crazy thing is? The grandkids probably not getting on a plane to come and see you because they grew up and they got jobs, and your own children as well. So proper planning, so you can develop money, make sure you're okay, and you've got the money to go and see your children as you want to do, or they want to come see you because you're living in a nice place. Either way, it takes money. And then obviously you need to make sure, if you want to leave your money to your children in the proper way, then maybe not even just wills, but actually looking at the whole structure, because who wants to leave their children a tax bill, right? So, particularly if you're a country that has estate tax or inheritance tax, just planning it properly. Okay, so with an advisor, because I don't want to leave it to the government. I don't know about you. Okay, so making sure it's done properly, whether it's the children or the grandchildren. Okay, it's nice to be able to give them a start in life. Tough enough in today's world without having a start. So if you can do that, okay, for me, that's a big one.
Amazing. You mentioned being an expat. So how can expats ensure the protection of their loved ones with a will?
Depends on the country they're in. So if you're in the Middle East, for example, you might have Sharia law. So you actually need to talk to an advisor and actually get to make sure you've got your will structured properly. So it isn't in a situation where Sharia law gives it to your son and not your daughters or whatever. So yeah, wherever you are, but wherever you are, in fairness, okay, a will's important. Okay, last one for luck.
The last one from YouTube. What advantages do international investment strategies offer compared to the local ones?
Okay, so good question to finish with. So yes, absolutely correct. If you're in a local market, you're buying in the local currency. Okay, so that might be good, might be bad, but if you're an expat, you can diversify different currencies. That can be very, very good for you. Could give you higher returns. You've got a wider market to actually invest in. If you're an expat, if you're dealing with international products, more funds available, more assets available. Okay, and also you've got currencies coming in to play as well. So hopefully that's clear for everybody. I know there was a lot to cover there. For me, it's time to be a Mike Tyson and spend your money on crazy things. Okay, don't be someone who leaves the money in the bank account, not making it work. Even if it's a small amount, make that money work. And then when you're investing, understand what you're investing in, okay, and get the best returns for you. And remember, a steady return is always better than something that you hope is going to shoot the lights out. Okay, hopefully that was clear. Okay, there was a PR code, a QR code there. We will send you an email afterwards. Available on all social media, as you can see by the questions. So you're more than welcome to go on social media, whether that's Instagram, YouTube, LinkedIn, ask questions, and I'll always give you a great advisor locally to talk to. Thanks for time, everybody. Hopefully, okay, everything was super clear. Thank you very much. Thanks again.